whose fault, and why wasn't I on it, and my employees, my shareholders, creditors, clients have taken a huge amount of pain. I wake up every single night thinking, what could I have done differently? This is a pain that will stay with me for the rest of my life. That's all.
On a humid September morning in 1844, a young Bavarian immigrant named Henry Lehman stepped off a boat in New York Harbor. Within days, he made his way to Montgomery, Alabama, where he opened a small dry goods store selling household items to local cotton farmers. He had no way of knowing that the modest enterprise he was building would one day become the fourth largest investment bank in America, only to collapse in the most catastrophic bankruptcy in United States history, triggering a global financial meltdown that would reshape the world economy. The Lehman story began simply enough. Henry's brothers, Emanuel and Mayer, joined him in Montgomery, and by 1850, they officially named their business Lehman Brothers. The firm operated in the heart of the cotton economy, where farmers would pay for goods with cotton rather than cash. The brothers quickly recognized an opportunity beyond retail. They began accepting cotton as payment and holding it until prices peaked, transforming themselves from shopkeepers into commodity brokers. By 1858, they had expanded to New York City, the emerging center of cotton trading, and helped establish the New York Cotton Exchange in 1870. Over the following century, Lehman Brothers evolved with America itself. The firm weathered the Civil War, financed the expansion of railroads across the country, and eventually joined the New York Stock Exchange in 1887. They backed some of the most recognizable names in American business, helping to fund Sears, Macy's, Paramount Pictures, and even the Radio Corporation of America. When the Lehman family finally stepped away from leadership in 1969, the company had grown into a Wall Street powerhouse, respected for its conservative approach and long-term vision. But the institution that emerged in the 1990s bore little resemblance to the cautious commodity brokers who started in Alabama. After being spun off from American Express in 1994, Lehman Brothers went public with Richard Fuld at the helm as chief executive. Fuld, known as the Gorilla for his intimidating presence and fierce competitiveness, had spent nearly his entire career at the firm. He survived the Asian financial crisis of 1997, when Lehman's stock plummeted to just $12 per share. Against the odds, he steered the company to 14 consecutive years of profitability, and by 2007, Lehman reported earnings of $4.2 billion. Fuld became the longest-tenured chief executive on Wall Street, and his compensation reflected his apparent success. Between 2000 and the bankruptcy, he collected roughly $484 million in salary, bonuses, and stock options. The source of all that profit and executive wealth came from a business that would have been unrecognizable to the Lehman Brothers who founded the firm. In the late 1990s and early 2000s, Lehman Brothers moved aggressively into mortgage origination. The company acquired multiple lenders, including Aurora Loan Services and BNC Mortgage, focusing heavily on subprime mortgages. These were loans made to borrowers with poor credit histories and low incomes, the riskiest segment of the housing market. By 2003, Lehman was originating more than $18 billion in mortgage loans annually. That number exploded to over $40 billion by 2004, and by 2006, their mortgage subsidiaries were lending almost $50 billion every single month. The business model was straightforward, but dangerous. Lehman would bundle these mortgages into complex financial instruments called mortgage-backed securities and collateralized debt obligations, selling them to investors around the world. But in a fateful decision, the firm kept the worst quality mortgages on its own books, while selling off the better ones. What had once been a respected investment bank had essentially transformed into a massive real estate hedge fund. By 2008, Lehman held $680 billion in assets, supported by only $2.5 billion in actual capital. Its exposure to commercial real estate was 30 times greater than its capital reserves. The warning signs appeared as early as 2006, when housing prices began to decline after years of unsustainable growth. As home values dropped, the subprime borrowers who had taken out risky loans with little or no down payment started defaulting at alarming rates. The mortgage-backed securities that Lehman held began losing value rapidly. In 2007, the firm was forced to close its own subprime lending division, absorbing a $50 million loss. Yet even as the crisis deepened, Lehman continued to increase its real estate holdings, acquiring more than $100 billion in mortgage-backed securities and related assets that year alone. By early 2008, the situation had become critical. Bear Stearns, one of Lehman's closest competitors, collapsed in March and was sold to J.P. Morgan Chase in a deal backed by the Federal Reserve. The markets immediately turned their attention to Lehman Brothers. The firm's stock price, which had traded above $60 just months earlier, began a relentless decline. In June, Lehman reported its first quarterly loss since going public in 1994 and desperately raised $6 billion in equity to reassure investors. It wasn't enough. On September 10th, Lehman announced it expected write-downs of $5.6 billion for toxic assets and a third-quarter loss of nearly $4 billion. Credit rating agencies threatened to downgrade the firm's debt, which would have made it nearly impossible to continue operations. Over that final weekend, Federal Reserve officials, Treasury Secretary Henry Paulson, and leaders from major banks gathered in New York to discuss a rescue. Several potential buyers emerged, including Bank of America and the British bank Barclays, but the deals fell apart. The federal government, which had facilitated the Bear Stearns rescue just months earlier, made a fateful decision. There would be no bailout for Lehman Brothers. At 1 o'clock in the morning, on September 15, 2008, Lehman Brothers Holdings filed for Chapter 11 bankruptcy protection. The numbers were staggering. The firm listed $639 billion in assets against $613 billion in debt. It was the largest bankruptcy filing in American history. That same day, the Dow Jones Industrial Average plunged more than 500 points, its steepest decline since the markets reopened after the 9/11 attacks. 26,000 employees worldwide lost their jobs. Investors who held Lehman securities saw their investments evaporate overnight. But the real devastation was just beginning. The bankruptcy triggered a cascade of failures across the global financial system. Money market funds, which had invested heavily in Lehman debt, experienced massive withdrawal demands. The interbank lending market essentially froze as banks refused to lend to each other out of fear that their counterparty might be the next to fail. Within 204 hours, the Federal Reserve was forced to bail out the insurance giant AIG with $85 billion. Within 2 weeks, Washington Mutual would become the largest bank failure in American history. The panic spread to Europe and Asia as markets lost approximately $10 trillion in value. The United States government responded with unprecedented intervention. Congress passed the $700 billion Troubled Asset Relief Program to prevent additional failures of institutions deemed too big to fail. The Federal Reserve launched massive bond-buying programs to inject liquidity into frozen credit markets. Yet despite these efforts, the economy collapsed into what became known as the Great Recession. By March 2009, the Dow Jones had fallen more than 50% from its 2007 peak. The unemployment rate reached 10%. Millions of Americans lost their homes to foreclosure, and retirement accounts tied to the stock market were devastated. The aftermath brought congressional hearings and public outrage. Richard Fuld testified before lawmakers who questioned how he could justify collecting nearly $500 million in compensation while leading his firm to catastrophic failure. Internal documents revealed that just days before filing for bankruptcy, Lehman's compensation committee had recommended over $20 million in special payments for departing executives. Yet despite extensive investigations, proving illegal conduct proved difficult. The firm had used questionable accounting practices to temporarily move assets off its balance sheet, but prosecutors struggled to build criminal cases. In 2010, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act, imposing stricter regulations on financial institutions and creating new oversight mechanisms. The law established stress testing requirements for major banks, and created the Consumer Financial Protection Bureau to guard against predatory lending practices. The global financial system had been fundamentally altered, with new safeguards designed to prevent another Lehman-scale collapse. The story of Lehman Brothers serves as a stark reminder of how quickly confidence can evaporate and how interconnected the modern financial system has become. What began in 1844 as a humble dry goods store in Alabama had grown over 164 years into a global institution that seemed invincible. Yet its collapse in September 2008 proved that no firm was truly too big to fail, and the consequences of that failure would echo through the global economy for years to come.